Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you a brief market summary for the week ending August 16th, 2024. And we'll also talk about some trading levels in the major market indexes for the upcoming week of August 19th. We're going to take a look at the SPY. We'll take a look at the NASDAQ, the Russell 2000, and we'll also take a look at the chart of the bonds. If we take a look here at the triple Qs here, which of course is the ETF of the Nasdaq, on July 9th, we had actually hit an all-time high at around 503. And then for the better part of 3.5 weeks, we kind of went into this swoon that went from here all the way down to here. And it kind of hit this little local low exactly 2 weeks ago today on August 2nd. And that was kind of noteworthy because of the fact that we were actually down about 11% from that all-time high. And of course, the financial press went wild over that because at that point we were in an official correction. For those of you who are new at this, anything 10% off of a local high is considered to be a correction phase. 20% would be considered to be a bear market, but 11%. So being 11%, we were in a correction phase. And then that was the close on that Friday. And then the following Monday, we actually had this big massive gap there. We gapped all the way into here. And in fact, when the gapped into there, we were actually down at that point a little less than 16% off of the all-time high. So at that point, we were only about 4% off of technically a bear market. But from that point on, for the last couple of weeks, we've clawed back a huge amount of that drop there. So now we're about 4 or 5% off of that all-time high. So that's kind of little market history for ever since for the last 3 or 3.5 weeks. But what's kind of noteworthy here is when this thing actually dropped into this level, we had actually had, if we look to the left here, we had actually had this zone already marked out. And this is what we refer to as a demand zone here. So what is this demand zone all about? This is an area where there was a consolidation um, and then an exhaustion of sellers. No one was willing to sell here anymore. And so at that point, and we're looking at a daily chart here. So on that next day, um, essentially buyers had to run up the price chart until they found willing sellers. And if we look in this area of consolidation here, if we think of the shares that are acquired by buyers, we can think of that as demand. And we can think of the shares that are offered up by sellers, and we can think of that as supply. And so within this region here, supply and demand were in balance. And so within that range of about 420 to 427 on the NASDAQ, supply and demand were in balance. And then once that gap occurred and then price ran up from there, obviously supply and demand went out of balance at that point. And so what was left in its wake, once we had this exhaustion of sellers, what was left in its wake was only demand. There was no longer any supply here. Consequently, we think of this and we call this a demand zone because there's no longer any supply. And so when price returns to a demand zone, quite often there will be additional buying that occurs. And so that's what we were actually waiting for. And so when price slammed down into this zone, that was actually something where we looked at that and say, okay, we can express a bullish trade out of it. Now, in all candor, we didn't just automatically buy into this because things were looking really ugly. At that point, that was obviously one big red candle at that point. We didn't just actually buy on faith. So what we actually did, though, is we waited for the close of the first hour. We saw price was recovering in the first hour of the session after slamming down into that zone. And then once that first candle closed after the first hour at 10:30 a.m. Eastern, that's where we actually got in, and that was that orange tick there. That was the close of the candle after the first hour, and so that's where we actually got in. And then I think over the course of the day, it had actually gone up and it came down, and it ended pretty much closed there. So we were actually kind of even, I believe, after that first day on that Monday. But then subsequent after that, throughout the week, we were in that. So we ended up with a nice trade that kind of ran from there to the close on on Friday, which was the August 9th. And so we actually had that nice trade that went there. But that was all predicated on this demand zone. And this is where we're expressing a bullish trade out of this zone. And so in terms of how do we express a bullish trade? Well, the most obvious way, of course, is you can simply just buy the Qs. But another thing most of our subscribers did is we bought calls. And some people bought them at the money, some people bought them out of the money. We pretty much ended up buying something, I believe, roughly with a 425 strike, and we bought it out about 60 days. Not that we were going to be in the trade for 60 days, but we bought it so that if we were going to be in the trade for a week or two, we would not get too hammered by time decay. And so that's the way we kind of expressed the bullish trade. And then, of course, another way one could have done that, if you wanted to collect premium, one could have also executed a bull put vertical credit spread, and that would have been a way to essentially put on a bullish trade, but in fact collect premium out of that demand zone. So those were all different. So those were all different ways of expressing a trade based on that zone. So where are we now? So here's where we are now. And actually, before we go on here, let me do the usual disclaimer here. All these trading levels I'm about to show you are for informational and educational purposes only. Precision Trading Labs, we are neither money managers nor financial advisors, and nothing here is to be construed as investment advice. So at any rate, here's where we are now. Okay, we just we price closed here on Friday here, and so right here we actually have a couple of areas of consolidation, and these are kind of. This is a qualified demand zone here. This one is kind of a little iffy here because price has not really gone very far since then. But these are two places where we could, if we got a pullback, we could in fact anticipate a bounce. And so this level right down here, that's about 2.5% down from where we closed today. And then this one is obviously a bit further down. And this one's about a little less than 5%, roughly about 5% down. So these are two potential areas where we could anticipate a bounce. And in terms of once price reached a particular level, this is what our trade essentially then would look like. We would enter here, and again, one could express the trade in any number of the ways that I just described. But what we would do is we would enter roughly there at roughly 463.5, and then this level here, when price price could be allowed to drill into there. We don't necessarily know it's going to bounce right off that front line, of course, but this would be essentially our region where we would anticipate price would turn and then start heading up. Okay, but if it doesn't turn from there, this is approximately where we would get stopped out, a bit behind the back line of this zone. Okay, so this is what our trade would look like. And so if we got a bounce to there, that would be a 1-to-1 trade. If it went up to there, it would be a 2-to-1 trade. Okay, that would obviously be a 3-to-1 trade each. Okay, and this is one level of risk in here. Okay, so that's how we would structure our trade. Okay, so right there, this is an area of demand, same, just like that. And then up here, this is actually above here. This is essentially the reverse of what I just showed you, except turned on its head. This is an exhaustion of buyers here. Price rallied up there, consolidated, and then notice that that huge gap, and then that very, very bearish move down there. Okay, so this is an exhaustion of buyers here. And so before, where supply and demand were in balance, okay, once the exhaustion of buyers occurs, what gets left in its wake is only supply. Hence, we call this a supply zone. And so but before, when we talked about expressing a trade, okay, this is how we would express a trade out of a supply zone. And instead, what we would do is either we would short the Qs. One could, of course, buy a put, and of course, to collect premium, one could do a bear call vertical credit spread. Okay, and that would be the way to express a trade out of this supply zone. But in fact collect premium. So this is the zone there, and so that's only about 1% above where we are now. We closed at around 475, and so roughly at about 480. That's where that supply zone is. So there's a supply zone sitting there, and then right here, sitting at the all-time high, this is another region where we could in fact express a potential bearish trade. Okay, so that's the story with the Qs. We turn to the SPY, which of course is the ETF of the S&P 500. Some similarities to what we just looked at on the Qs here. So here's where we closed here. Here's the all-time high on this. This is actually only sitting about a little more than 1% up, which differs from the Qs, because I believe we're, in terms of where we are off the high on the Qs, you can see there's a level there which is 1%, but in terms of the actual all-time high, okay, that's about 4% from where we are now, which of course is different on the SPY. Okay, so the SPY we're only about 1.5% or so off the all-time high. So this is where we would express a bearish trade. Okay, and that's at around 562 or so. And of course, it also depends on how much energy how much energy is in terms of the approach to this. If this thing goes slamming into this, we might just be a little cautious about getting into a trade there. But if it kind of goes in a leisurely fashion, then this would be certainly where we would express a bearish trade. Okay, and in terms of the bullish trade, right here, here's a demand zone here. Here's a rally-based rally formation. Again, here's the exhaustion of sellers that I talked about a couple of minutes ago. And so this is where we would express a bullish trade here. So that's about 3.5% down from where we closed today. And again, that supply zone is sitting a little less than 1.5%. Okay, and so those are our levels that we're going to be watching on the SPY. Taking a look at the Russell. And this is a good illustration that not every chart has a setup, at least for our purposes. There's really nothing that in the near term that we actually find of any quality here. There's just a whole lot of churn here. There's a whole lot of congestion here. For us, there's just really no trading level on the Russell 2000. So a while back there certainly was. Up here, in fact, a couple of weeks ago, we actually had a nice trade out of this supply zone up here. And this is actually a zone that went all the way back to 2021. And this was that area right there. Okay, right here we had this drop, and then a base, and then a drop there, and so that's in fact where we had expressed a bearish trade out of that, and that was actually right at the end. That was a zone that was right at the end of 2021. So that was actually a long time ago. Okay, so ever since then, prices dropped out of here, and again, if price actually came back to that region again, we could probably see taking a trade out of that again, because of the fact that price really only glanced off of this and didn't really penetrate to any great degree. So probably there's still supply that's left in that region. But other than that, there's really nothing that we like here. And if there's really a pullback, this is really the first place that we would actually be looking to take a trade, and that's at that 187 level. So that's obviously a long way away from here. So there's really nothing in terms of a buy point that we really like on the Russell 2000. So that's the story with the Russell. And lastly, we'll take a look at the TLT. The TLT, of course, is the ETF of the longer duration bonds, 20 years of duration and beyond. So here's where we closed here. Right here above, about 2.5% above, roughly at about the 100 level on this. There is a level of tested supply. So what do I mean by that? Well, we had it. There was a supply zone that had formed, And let me just show you what that looked like here. Okay, so right here, this is an area where a supply zone had formed in August of last year. Price had dropped there, consolidated, and then notice then that gap, and then that sudden move down there. So this was an area of supply, but that has now been actually been tested. Okay, so price went up to there once, okay, and has been back there a couple of times. So consequently, it's already been tested twice here. So if it comes up here again, we would not really expect it to hold. So in fact, if price came up to here, we might actually use this as the basis for a breakout play to the upside because of the fact that price has actually been back here a couple of times. And the more often price uh, uh, drills into a zone, the weaker it actually gets. So, in fact, this would actually potentially be the basis for a breakout play to the upside. So there's really nothing above here in the short term that we would be looking to short on the TLT. On the other hand, right here, if we did get a pullback here, this would be the place where we would actually express a bullish trade right here. Price route, okay, because more or less we have this little area consolidation, and then notice that race up there. So this is an exhaustion of sellers here, and so that's that whole narrative about leaving a demand zone in its wake here. So, and that's about 4.5% down. So there's really nothing of quality above here to short. But down here, this would be an area I think that we would be looking to potentially express a bullish trade down here. So at any rate, that's what I got on the indexes. This is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and I'll see you next time.